If your portfolio holds companies relying on cheap imports or global shipping, the math for their future cash flow completely broke today. Today, the Supreme Court struck down the old tariffs, but the president immediately ordered a new 15% global tax. Then we track how this supply chain shock meets a sudden oil spike in the Middle East. Finally, we will look at why the central bank is stuck and how artificial intelligence spending is ignoring the economic slowdown. Let's translate this into cash flow. The Supreme Court ruled the old emergency tariffs illegal, but do not expect a quick refund. The president just announced a new 15% global tariff using a different law. Importers must pay this 15% upfront at customs. Consumers are already spending less, so companies cannot easily raise their prices. This means the 15% tax eats directly into gross margins and drains cash before the products are even sold. In the Middle East, Iran temporarily closed parts of the Strait of Hormuz for military drills. Roughly 20% of the world's oil goes through there. Because of this bottleneck, crude oil spiked above $67 a barrel. When oil goes up, delivery trucks and cargo ships pay more for fuel. They pass these costs to retailers through fuel surcharges. Higher shipping costs shrink operating margins for anyone selling physical goods. The economy is slowing down, but prices are still going up. Fourth quarter economic growth dropped to 1.4%, but inflation actually heated up to 2.9%. Because inflation is sticky, the central bank cannot rescue the economy by cutting interest rates. Federal Reserve officials warned that the new tariffs will keep inflation warm. Because the Fed is stuck, the 10-year Treasury yield climbed to 4.08%. Higher borrowing rates mean less free cash flow for companies carrying heavy debt. The government admitted they overestimated last year's job market. They erased 403,000 jobs from the 2025 records. However, sectors like healthcare are still hiring fast. If you run a service business in those areas, you still have to pay high wages to keep your workers. Rising payroll costs squeeze cash flow immediately, especially when the broader economy is slowing down. While the normal economy slows down, big tech is spending billions on artificial intelligence data centers. NVIDIA reports earnings next week expecting $65 billion in revenue. Tech giants are expanding their budgets just to buy these advanced chips. For semiconductor makers, this massive spending turns directly into high margins and huge free cash flow. Artificial intelligence is acting as the last reliable growth engine in a slowing market. A new tax bill promises no taxes on tips or overtime. But do not expect retail sales to boom tomorrow. Changing tax forms takes time, so the extra cash will not hit consumer bank accounts immediately. Retailers reporting earnings cannot rely on a sudden shopping spree to save their profit margins this quarter. Watch the 10-year Treasury yield tomorrow to see if borrowing costs keep rising. Also, watch if oil stays firmly above $67. Rising costs and sticky rates will punish companies without pricing power. This is not financial advice, but a translation of how news becomes numbers. Consider subscribing, and see you tomorrow.